Hey, what's up, everyone? This is Kirk here again at OptionAlpha.com. Just getting done with the workout, and I want to jump on. I actually want to jump on yesterday and talk a little bit about earnings. You know, it's been a topic that people have had coming up here just in the last week or so. Everyone's been asking about earnings trades, how to do them. We're actually going to get really deep into earnings season here this week. I think really most of the companies start really announcing this week. Last week we had some like JP Morgan's, some of the banks and stuff like that. But this past week we had like Netflix, and we're really going to get thick into earnings season now. So I want to kind of talk through earnings season. Obviously, if you're joining in or if you're watching now, if you have a question about earnings, just shoot them in the comment section right below. But earnings trades, when it comes to options, really what we're trying to do is just mainly take advantage of just that one-day drop in implied volatility, right? So all we're trying to do is, look for a stock that has really high IV rank heading into an earnings event. And what we know is that once the earnings event passes, whether the company announced great earnings or bad earnings or whatever the case is, we see consistently long-term, not every single time, but consistently long-term, a huge drop in implied volatility because now this unknown event is past us, right? And so everyone thinks that the rise in volatility that's heading into earnings season is because, people expect, the stock to make a big move. And then when the stock doesn't make a big move or moves less than expected, we get this drop or contraction in volatility. And that creates a huge opportunity for options traders. In fact, what I often tell people who are new to trading is that if you really want to learn a lot of the basics of trading and the mechanics, you basically take an earnings season, right? And it compresses the entire time for an options trade down into a single day, right? So it's really fast. It happens really quickly. And that for some people is really challenging and kind of scary. But the reality is that you can learn a lot from an earnings season, and going through it, you can get a lot of trades on. You can learn the mechanics of entry and exit literally in the same, within 24 hours, right? You can learn how to make adjustments, etc. So questions that people had on earnings trades. And again, I see a bunch of people join in here. So if you have questions on earnings trades, throw them in the comment section real quick. But questions that people always have about earnings trades are things like, like how can I do them safely? How do you set them up? When's the best time to do them, right? And so we're going to talk through that here on today's live session. So the first question that everyone always has is, when do you do the earnings trade? Like when do you actually initiate the earnings trade? And the reality is that the best time to initiate the earnings trade, at least in the options world, is to initiate it literally as close to the close of the day as possible before the earnings event happens. So before the company actually announces earnings, you want to initiate that trade as close to the end of the day as possible. So if you have a company that say, let's announcing tomorrow morning, right? You try to enter the trade today. If today was a trading day, you try to enter the trade today as close to the end of the day as possible. If the company is announcing today after the close, you'd still initiate the trade today as close to the end of the day as possible. It's always the session before they announce earnings, as close to the end of the day as possible, right? Now, this doesn't mean that you try to get the trade in literally 2 minutes before the end of the day, but, within reason, right? You're not entering the trade, in the morning. You're entering the trade in the afternoon, 3:30, somewhere around there, East Coast time, so that you are trying to be as neutral to the actual event as humanly possible. So what a lot of people end up doing that really screw this up is that they try to end up getting into these earnings trades even the morning before or the day before the event. And what happens is that the stock makes a big run that day, right? Or a big run leading up to it, right? And so you just want to be as neutral as you can heading into the event. Like, it doesn't matter. Like, it drives me crazy that everyone wants to try to take a direction on an earnings trade. Like, I don't care where a company goes when it announces earnings. They can go higher, lower, whatever. As long as it moves within the expected range, I don't care. I'm not trying to take advantage of that. So if you're an option seller and you're trying to take advantage of earnings, you have to realize that all you're really trying to take advantage of is just the drop in implied volatility. So do yourself a favor and make your position as neutral to the actual event as humanly possible, right? Like, don't give yourself an opportunity to skew it one direction or another. Like, your opinion of this doesn't matter, right? And I'll give you guys just like a little backstory on this, but when I was working in REITs, and I was an analyst, I used to talk to CEOs and CFOs, and I would know basically what the numbers, should be for the company coming up here in the next quarter, right? And so I'd sit down with them and say, like, what are your numbers? What do you guys project, right? Like, where do you guys think things are going, right? And they'd say, we think that things are going really well, right? Like, we'll have a great quarter. And so I knew that they were going to have a great quarter. They knew that they were going to have a great quarter. But when they actually announced, then the stock dropped, right? Because everyone's expectations might have been higher, right? Or the stock didn't rally as much as people thought it was going to be. They still had great numbers. They still, beat top line revenue, bottom line, everything, right? But the company just, the stock just sold off. Investors didn't know. So what I'm trying to tell you is, like, people, you don't know where the stock is going to go, right? Like what you think is good news, everyone else can see as bad news and vice versa, right? So make your position as neutral as you can. And that means getting into the trades late in the day, as late in the day as possible, right? So that's the first thing. The second thing that you have to understand about earnings trades is you've got to get outside of the expected move. So we've got a ton of videos on Option Alpha. You can check those out. They're all free, obviously. We have a whole course on earnings trades that's totally free that you can go through. But the thing is, you have to get outside of the expected move. A quick and dirty way to see what the expected move is to price out the at the money straddle, right? There's a market maker move that most of you can see inside like Thinkorswim or Tastyworks or any of these other broker platforms, but you have to look at the expected move for that 1 day event, not until expiration, but for that one single day event. That usually means looking at the weekly options for whatever week you're trading in, the front weekly options for that earnings event. And you have to look at the expected move. And if the expected move is say like $2, you've got to get outside of that expected move, right? So that's a huge thing for me when I make trades is if I see a trade that the expected move is $2 and I can't sell any options outside of $2, like I don't care how great the volatility is. I don't care who the company is. You just can't get outside the expected move and make some money, right? Now, the expected move, for those of you who are just joining in, of course, I see a lot of people on here. So if you are watching this and you have comments about or questions about earnings trades, please get them in so we can get them on here. But the expected move, for those of you who are watching or new, is the 68 to 70% probability range of how far that stock might move after it announces earnings. And it's really only good for that day, right? That one single day after the announcement is done, right? So if a stock is trading at $50 and the expected move is $2, then we kind of sort of expect the stock to trade between, $48 and $52, right? Now, this can be really wide. Like a Netflix could have a, $100 expected move, right? So $100 up or down. But you have to figure out what that number is, and you've got to get your position outside of that. So you have to sell options either outside of that number, or your break-even point has to be outside that number. So you could do the at-the-money straddle if you want to. And we often do that a lot here at Option Alpha. We sell the at-the-money straddle, and we're selling at-the-money options, but our break-even point moves us further out from the at-the-money price and gets us outside of the expected move. So I think that's the second key to doing earnings trades is, no matter what you think the setup is, how great it is, you've got to get outside of the expected move. The third component to doing this, obviously, is keeping the position small for earnings. Like I could probably rattle off like a million different trades that went really bad for us, at certain points with, large moves. And it's nothing that we did as far as like entry was bad or anything like that. But the position size that we had kept us from losing a ton of money on trades just because the stock made a larger than expected move, right? So just because we know that a range might be $2 up or down doesn't mean that the stock can't move $20 in one direction, right? Now, eventually that's going to course correct. And over time, the market will reprice, the options heading into earnings because now they have to price in maybe a $20 move the next cycle, right? So it doesn't mean that your trade was bad or anything. You just have to keep your position size small, especially for these earnings trades. And even more so for those of you who are new to just getting started, like this is why I tell people like earnings trades are a great learning tool. Like they take the whole timeline and compress it down to seriously 24 hours. And it forces you to focus on the really, really key important components of this whole thing, right? Thanks, Jordy, for saying I'm fake. Appreciate it. Love it. Trolling around like always. So yeah, it forces you to focus on these key components here for 24 hours, right? So you can learn the mechanics, you can learn how to get it done, and then you can move on to the next trade. And you can get literally maybe, 50 to 100 trades done in the course of a couple weeks and learn how this whole process works, right? The fourth and final thing that you have to learn about earnings trades is you have to get them off early, right? So don't hold them to the end of the day, right? If the trade is a winner, a loser, right after the event, again, all we're trying to take advantage of is just the move in implied volatility. Like we don't care if the stock moves up $5 or down $2 or whatever the case is. We have to take advantage of the move in implied volatility. And that usually means that that's going to happen and reprice quickly after the market opens, right? So you'll have a stock that opens up and maybe doesn't even trade that high or that low, right? But then you have that drop in implied volatility and all the option prices go down. That's when you want to take advantage of it. So it could happen, 2 minutes after the market opens, could happen 3 minutes or 5 minutes after the market opens, but shorter in the day is when you want to take those trades off. You don't want to be waiting until the end of the day because, again, as company news starts to disseminate and people hear about the earnings event and what happened, then it might cause the stock to have a huge rally. Case in point, and this is a case study that we have up on Option Alpha because not afraid to show any of these trades, obviously. We had an earnings trade that we had in Chipotle, and this is probably about 2 years ago now that we had this earnings trade. And what happened is that we had a perfect move in Chipotle, meaning it barely moved after the earnings announcement. Implied volatility got crushed, and we stupidly let the whole position on for the rest of the day. Like, I even walked away, went to the gym, hang out with my family, the whole deal. And I was thinking to myself, like, hey, like, this thing is a great, it's $50 away from any of our strike prices. Nothing's going to happen. We've got a full winner. I'm just going to let this thing expire for the rest of the day, right? And so I come back later on in the day, and Chipotle's made a $150 move in its stock price. So just like a huge move in that day, right? And I had a total 100% winner. It probably would have cost me $20, $30 in commissions to get it off, right? But I lost a couple $100 on that trade because I just didn't get it off early enough in the day, right? So again, the key is take advantage of what you're trying to take advantage of. Take advantage of implied volatility, keep your position size small, and don't get too directional with these earnings trades. So hopefully this helps out. If you guys liked it, enjoyed it, please add a comment. Let me know. We'll be back on here maybe, I don't know, later on tonight or tomorrow, talk about kind of the weekend routine here at Option Alpha and looking at the portfolio for next week. So appreciate you guys joining in, and we'll talk to you guys soon. Bye.